Hi, everybody. Good turnaround Tuesday. Hope everyone's doing okay on this 4th of July week. Kind of breaks it up. A lot of people taking the whole week off. I want to start off with Dixie. Last week I talked about a potential recovery to 96.80, and Steve will be with us. And I recall last week he had the market coming back to retest the breakdown right around here. 660, 680, 97 is a possibility. So from here, we broke 200 points. So this is about halfway back. Maybe we try 97. Okay, so, this is the type of thing where, I was telling people you scale in, you put a piece on at 80 or so, and maybe another one up around 97. If I'm a dollar bear, I don't want to see the market closing back over 97.20. That's going to change the picture for me. And I do want to give you a little bit of a tip on when is a good time to fade dollar strength. And your first key is you could use euro pound, or you don't even have to use euro pound. The best days to look to short the dollar is when the euro, which right now you can see is up 12, and the pound is down 10 pips. So when you have leadership with euro over pound, and this isn't new. In fact, I used to do it with the D-Mark and the Swiss. Okay, so, I would keep an eye on that. I know Swiss has changed since the pegs and all of that, but just like you use Aussie Kiwi for telling you what your preferred long and short is, the best time to be looking to short the dollar and buying the euros when it's showing relative strength against the pound. Everyone with me? Give me a Y if you are. Hello, Hamid. How are you? Everyone doing okay? So you could plug it into the chat box or the question box. Okay, glad to hear. So the key question regarding the dollar right now is the yen done? Now, a lot of people are going to play looking to fill the gap. But if you did that back here, look how much of a failed strategy it was. Never got to the gap. And this is interesting. We don't get a lot of gaps in FX. And normally when they happen on Sunday night from a Friday's close. So it's possible we fill the gap, but if we don't and we start cracking back through this 108.50 level, and I know Steve has something up around the 109, that could change the picture in the end. I'm still constructive. And with that being said, let's take a look at yields. They're trying to turn, and I still think the 10-year has a shot for 217. So here we are, just flat. Could we get one more shot down? Yeah, we could. But it would not confirm. So we have a lot of divergence here in the 10-year, and I'm thinking we could get up to this blue moving average on the 4-hour 216. And if that's happening, it's hard for me to see much downside pressure in US dollar yen. Okay. And the other corollary with US dollar yen is having a decent day. I'm speaking about gold. And what a, good call by Adam yesterday to say, don't complicate your precious metal trade with silver, with gold up 0.5% and silver flat. Actually, back under this breakdown, if silver closes here, it's tried to hold this looking like a false breakdown, but this does not look good today. Okay, so silver actually looks like it could be a short with stops over, say, 1530-ish right here. Because if this formation is live, 1520, you're talking about 1490 or so in silver back down here. So be careful if you're bullish precious metals about trying to buy the weakness. And the weakness still is silver. Take a quick look at the gold silver ratio. It came back for a few days late last week. Let's see if it's if it's making new highs. No, it's not making new highs. But this was a double top. I really can't call this a divergence. Why can't I call this a divergence? Anyone in here know? Hi, Claudia. Take a guess. Hiya, Charlie. Okay, going once, going twice, because you can't call anything a divergence if it didn't make a new high. This high was 92.97, and this high was 92. Oh, you know what? You could. It took it out by 1 pip, so it was a divergence. Okay, so we'll see. Back to resistance. Maybe we get one more blow off in the gold silver ratio. Let's see what else I wanted to cover here. I think that's really, the dollar is important to me. So a lot of people are saying, and I could see how the case, that maybe we put in the top in the S&Ps. I'm still going to be patient. There's some GAN dates mid-month, and we also have the Fed mid-month. We also have Mueller going to the Hill mid-month. So I'm holding off for topics. I'd like to see the big round number. Maybe that's a hook for a lot of people not getting short, because I think the whole world's looking for 30, 30, 30, 50, a lot of fib counts up there, Elliott counts up there. So we'll see. I'm not shorting this market until we get that. Maybe this is 1 and this is 2. We get a pullback. 29.40 is going to be pretty important, just like 29.10 was important. So we'll see how this plays out. And just one more thing in crude. I wanted to show this. So, I took a shot up here yesterday morning. I only traded it for 40, 50 pips. It was good for 140 on this candle right after face. And this is why it stopped. Look at how it came right off the 50-week moving average. I mean, it's perfect there. So you could be short with stops over that high at 60, big round number. Initially just looking for 57, maybe 55 on an extreme basis, but yesterday's candle was not too constructive. It still closed up, but way off its highs with a bullish development in OPEC extending the cuts. So if you're a bull on crude, I'd wait for a pullback to be a buyer, because we stopped here. So this was a pretty good rally, about $8.50. Why can't we pull back 4.5? That would give you 56, 56.5. And 56 was a big number for like Shy Girl and Grega. 56 was a big number. So maybe we're going to come back and see if that number can provide a launch pad for the next move up in crude. If that's going to happen, I'd say close it back under 56. This market's in trouble, and we will be challenging that low that we put in right around 51.5. But I wanted to show you that you can use your moving averages. For a 2-week reversal, it's going to really have to do some work. 57.37 is a 2-week off number. So if we have a close by Friday after the NFP under 57.37, that would be a 2-week reversal, something for you to pay attention to. Okay, so Steve is back with us today. And I don't know about you guys, but I could come in here without one idea, not one, and listen to Steve for about 20 minutes. And I have several, or at least a few, compelling technical setups that he brings to all of our attention every day with his great work and disciplined attitude about waiting for confirmations and not trying to get the edge and then being stuck with the knife because you're trying to get a lead on something that hasn't manifested yet. So Stephen, you know, the whole team is glad to hear that you're back, and Jason's doing well, and you're probably exhausted from hanging out in a hospital, sleeping in a chair. But welcome back, brother.
Hey, Dale.
How are you, man?
Good. How have you been?
I'm doing okay. You know, we miss you when you're not here, bro. You know.
I miss you too.
No, we don't.
Yeah, okay. Well, Stelios doesn't. The rest of us do, okay? You know, it's almost like face is kind of like missing an ear or a nose or an eyeball when you're not here. You don't have the whole face when you're not here, buddy.
Nice.
So, you know, I remembered a few things you said, and I'm wondering, you know, if you want to start off with the dollar. I think this was a zone that you were looking to maybe sell into. Is my memory correct, or do I have old timers?
No, you don't have old timers.
Okay, I just am an old timer.
Yeah.
Okay.
Yeah.
All right. So if you want to take over the screen.
Yeah, let me take the screen. So let's see what we have. There we go. Let me also open the chat. Perfect. Okay, so a few things here. First of all, we see a pullback in several dollar pairs, prominently, for example, Euro USD. So the question is, you know, is that a failed move that we saw? You know, I bet a lot of people are thinking that perhaps they got trapped in the wrong direction. Answer. I have no reason to believe so. So, you know, in the 2 days that have passed, 2 days of 1.5 days of price action, nothing has changed in my viewpoint. I have no reason to be looking to buy dollars yet. I'm still in sell dollars mode. And for example, Euro USD is currently back testing support. So I wouldn't be surprised if we, you know, pushed higher from here or from a little bit lower. If you want, you can even draw like a little trend line, like, you know, something like this.
Yeah.
And, you know, look at this for confirmation that we're not breaking lower. Okay, now if we break below this trend line, I admit that things will start becoming, you know, less easy. But
ballpark wise, 112.40.
Are you a little bit far away from the microphone now, Dale?
No, I just put it up. So
yeah,
112.40 about would start to put into question this euro move.
Yeah, I guess somewhere there. Yes.
Okay.
Yes.
Thank you, bro.
And USD Swiss, we did expect another leg higher in the USD Swiss, if you remember. That's what we drew last week. Another leg higher, perhaps towards 98.50. We've overshot that by a little bit, but keep in mind that USD Swiss has already broken below a long-term triangle, which means that for this one as well, I have no reason to be, you know, looking higher, because I think that the chances are still very, very decent that we're going to continue lower, you know, anywhere between here and parity. Okay, I wouldn't definitely want to see it above parity, because then we're talking about something totally different. Now, the DXY is currently backtesting this previous ascending channels support as resistance. So this one is also at resistance. Now, if we go to the Aussie and the Kiwi, first of all, if you remember, Dale, on Friday, I said that both the Aussie and the Kiwi were great short opportunities from a risk-reward perspective, that, you know, a pullback from equivalent levels, because both of them were on confluence of resistances, would be welcome. And I think, you know, that they provide some very nice risk-reward opportunities, because you could risk very, very little and look for a pullback and that's what we got, both from from the Aussie and the Kiwi. Here they are. But now that we've seen a pullback, first of all, yes, there can be a little bit of a continuation, but does that make me immediately bearish? No, it doesn't, because I want to see how this is going to unfold. For example, Aussie is, decently rebounding today, not as much having to do with the Kiwi. I have to admit that both of them got rejected from, very key resistance areas. So, that forbids me from being outright bullish yet. I'm more, on the neutral side. But given the fact that I'm very cautious about the dollar and I still think that the dollar can move lower, even if this is a corrective move, I wouldn't bet against them eventually breaking above these resistance areas and moving higher. Having said that, having a look at what the Aussie and the Kiwi did, and going back to the Aussie Kiwi, you're going to see that we have a very, very interesting candlestick forming today, considering two things. First of all, that this move lower has, everything you expect to see from a corrective move. It's slow, it's overlapping, and, it took so long to retrace a portion of the move higher, which took, less than half the time. And, on Friday, we broke and closed below the 61.8, but this seems to be, given today's candle, probably, a false move. And considering that, we found support exactly at this descending channels support, I think that the Aussie Kiwi might be trying to send a signal here that, this move lower might have already ended. Okay. I know it's early to say so, since we're back in the middle of this descending channel, but this candlestick shows some momentum. I want to see how the day is going to close, and if we do continue like this, I believe that an eventual break above 1055 is going to extend higher. And by how much? I think the easiest thing to do here is to look for a perfect extension, 100% extension of the first leg higher, which would take us up towards 1087. Okay. A little bit lower is the 61.8, so I think the 61.8 is a satisfactory target. Of course, all that assuming that we found a low here. You have two choices. You can jump the gun and buy it here and put a stop loss below the lows, in which case you have a better entry point but less confirmation, or you can wait for a breakout, in which case you have a worse risk-reward ratio but a much higher chance that this is actually going to work out. In any case, I'm closely monitoring the Aussie Kiwi. Another reason I'm doing so is because I'm looking for exposure in the crosses, like Euro Aussie, Euro Kiwi, Pound Aussie, Pound Kiwi, and knowing that the Aussie is going to overperform the Kiwi for a period of time will help me make the correct choice. As I said, that's not a given yet. I want to see how we're going to close today, and I want to see if we're going to get continuation tomorrow. But I'm getting prepared for a likely period of overperformance of the Aussie over the Kiwi. Okay, so that's one thing I'm paying close attention to. Keep in mind that Aussie yen, we saw that on Friday as well, got rejected from that area of resistance, confluence of resistances as well. Now, I want to see more to say that, this makes us bearish, but perhaps, something like that is going to happen and we can continue higher. But, for a fact, this resistance area proved its importance just by creating that candle on yesterday after Friday, and Kiwi yen, more or less the same. Kiwi yen had managed, though, to produce a higher high before doing so. I would be careful. This area might now act as support, so 72 might be enough of a pullback. We might see another push higher from here. I'm going to monitor closely and see what happens by the end of the day. Now, having to do with stocks, unsurprisingly, they continue higher. I kept saying that, you have to be careful because I see nothing bearish with stocks. I have to be honest, I was expecting another little leg lower from the S&P before higher, but that didn't actually manifest. So, ideally, I would have loved to see a move back towards like 2870. In that case, I would have bought the S&P as well, because I bought the previous week, I bought the DAX. If I had seen 2870, I would have probably bought the S&P as well, looking for higher prices. Regardless, I see nothing bearish with stocks. I do see a little bit of a divergence on the daily, on the RSI. Who knows? This might be an irregular correction that might be flat. So we might even now pull back towards that area, like for an ABC, like an ABC. In which case, if we're lucky and we see that level, what I said before applies. I'm going to buy the S&P, looking higher. Keep in mind that stocks having to do with the backdrop, the fundamental backdrop, stocks are like the coyote running behind like the beep beep. So I think that
the roadrunner, yeah,
the roadrunner, yeah, exactly. So I believe that they're now like walking on thin air. We see clear signs that the U.S. economy and the global economy are headed towards a recession. Of course, they're going to do everything they can to stop it, but I think they can only postpone it for a little bit. And trust me, no matter what the Fed or any central bank does from the perspective of monetary policy, if we go into a recession, stocks won't be able to, to hold these valuations because, simply put, they won't make any sense at all within a recession, no matter how stimulative the monetary policy is. So, bottom line, I think that if you're looking longer term, this is not the place to be buying. But if you're looking to trade like short to medium term, I think that this irrational push higher can continue longer. The technical perspective says it can, so I have no reason to try to fade it. Okay, so if you're if you're conflicted because of you're looking at the general environment and you want to be bearish, but you're looking at the chart and the chart tells you that you shouldn't be bearish, just stay on the side. But I don't think this is the time to be shorting yet. Okay. So, if you don't want to be long, just, be on the side until we actually get a signal that, something is changing. And trust me, when something starts changing, there's going to be so much potential downside that even if you lose the first 5%, it won't matter at all, literally. NASDAQ, same deal. It hasn't posted new all-time highs. So in that sense, it's a little bit divergent from the S&P. But, the technical picture here as well is quite bullish. The DAX yesterday actually hit my next target, which is this horizontal support resistance area, and the 70 and the next area I meant is the confluence of the 78.6 and that area. But nobody says that we can't get a pullback before that. So, for example, we might even get something like this. But what doesn't change is that, the picture is still quite bullish. Same thing with the FTSE. You can see it here. We were expecting a continuation higher once we broke above that pennant, and that's what we're getting. The RSI is entering overbought territory, which is another confirmation that the trend is higher. So, everything looks just fine to the upside. Even the underperforming Nikkei is, trying to move. Now, as I said it the previous week as well, I wouldn't be buying the Nikkei because, if you want to be long stocks, there are, indices that perform much better than the Nikkei. Keep in mind also that yesterday we hit resistance in the Nikkei, so let's see what happens from there. But even the Nikkei is, performing decently during the past few weeks. So having said that, let's go back to some of the commodities. Let's start by crude, and then we can have a look at the metals. Crude is clearly consolidating at current levels. Now, the longer it keeps consolidating without pulling back, the higher the chances that it's going to have another leg higher. Okay, so, that's a likely scenario. Let's have a look at it on the 4-hour chart. But the fact that we have a clear loss of momentum is definitely the case. This is what we were looking for last week. More or less, this has happened, actually. And the next upside area is at 6150, 6180. So, likely we're going to see another push higher towards that area before lower. Now, there is a chance that we're just going to fail from here. In the case that we, move below 5750, I think that, we can easily extend towards 55. Until that happens, I still, kind of favor another leg higher, although I have to be honest, at this juncture, I wouldn't be buying or selling, but I know that, many of you like to see what's happening with crude. And since you every day ask, why not have a look at it? Now, having to do with gold, as you know, I was expecting a pullback from there. We are getting this pullback. I think it's a healthy pullback. I'm definitely looking to buy the dip as long as we remain above 1360. I still haven't started scaling in, although perhaps I should. I'm going to see what's going to be happening today before I take any decisions or any action. Same thing with silver, although as I've said multiple times, if I am to buy something, I'm looking to buy gold. So I don't really care that much about the technical picture in silver. Having said that, silver is also pulling back in an orderly fashion so far. So obviously, if gold propels higher, silver is going to follow. Likely, not following the same pace. As Coach said before, gold-silver ratio remains in a clear uptrend. We've now broken above a multi-year ascending wedge. So, I have no reason to try to fade this trend, meaning I have no reason to try to buy gold instead of, silver instead of gold. Okay, now, copper, if you remember, I was very, very careful with copper because I expected that there's a decent chance we're going to get rejected from that area. And, so far that's the case. Now, if we break below this channel support, then I think that copper is going to continue lower with the next objective being this 255 to 256 area, which is the one I was looking for since we broke below this 285 area. So, copper doesn't look that healthy, as a matter of fact. Palladium keeps looking, fine, but I would be quite careful here because we're testing previous area of resistance. And as it seems, there is a clear loss of momentum as well. So Palladium is in need of some type of a pullback sooner rather than later before continuing higher. So something like that would definitely not surprise me. That's probably going to offer a nice opportunity to be long Palladium. Now, having to do with yields and bonds, not much has changed since the last time we had a look at them, which means the bond is still pushing all-time highs, but there is a clear loss of momentum here. So I'm actively looking to either short the breakdown from this wedge, or if we get another push higher from that wedge, perhaps an extension towards the 161.8, then be short that one last thrust for a short-term trade, for a short-term pullback. And probably, the treasuries are going to do something equivalent. They're still trading within this ascending channel. Clearly, they've lost momentum, but clearly they haven't broken down yet. Okay, and here are the yields. Yields consolidating once again. This might be another little triangle, which means that it wouldn't be a surprise if we saw another thrust lower, after which, though, I would probably expect stronger rebound. So something like this can be resolved to the downside, and then like this. But then I would expect like a stronger rebound higher. Okay. So that covers that as well. Let me go through some questions. Would I buy the EuroCAD? No. I haven't had a look at it since like yesterday or the day before yesterday, but I remember somebody asked the same question a few days ago. So I remember that the answer is no, because we've been breaking down below this triangle, and that tells me that there might be another leg lower before higher. So no, the question is, gun to my head, I would be selling it, although I want to do nothing with it because from a technical perspective, it's not that clear. But if I was forced to do something with it, I would rather sell it than buy it. So the answer is no, I wouldn't be buying it. Are you bullish Aussie against Euro or Pound? Let's have a look at them and, you'll know the answer. There was a question about the USD Swiss and the gap. Oh, that gap. Yeah, I think we're going to close that gap because, as I told you, I still believe that we might have more downside. So I believe that this is one of those gaps that are not going to stay open for a long period of time. Okay. Now, Euro Aussie, going back to the question, Euro Aussie, after this nice failure there, is currently testing horizontal support resistance area and 38.2% fib from this move higher and the 50 DMA bottom line at key juncture. I think it's going to actually break down from here. Now, is it unlikely that it's going to rebound a little bit and then continue lower? No, it's not unlikely at all. Is it unlikely that it's just going to resume higher? No. But my intuition tells me that we are actually going to break the support and then continue lower. Okay, and yes, I do think that this confluence of supports is important. So I do think that breaking below this confluence of supports is going to be a very, very decent confirmation that there's more downside coming. Euro Kiwi, striving to hold this previous low here at the 200 daily moving average. Perhaps we're going to see something like this. But I also believe that there's more downside here. Even if this is a correction lower, I do think that there should be another leg lower. And now let's have a look at the equivalent pound pairs. They look worse, obviously. Pound Aussie, perfect. That's actually, we had a look at that on Friday. Let me zoom in so you can see it. On Friday, we were rebounding. And despite seeing that bullish candle, I said that, listen, I wouldn't be surprised if we get rejected exactly from here because this is support resistance area, this time acting as resistance, the 200 daily moving average. So we might get rejected from here. And that's what seems to be the case. We're getting rejected from there. So I think that Pound Aussie looks quite weak. A nice candlestick reversal yesterday from the Pound Kiwi from the 61.8. So I do understand why somebody would be a little bit skeptical here. But as it happened with the Pound Aussie, I wouldn't be surprised if this just brings like a little rebound and nothing more than that. And we resume lower from there. So I still favor the downside for the vast majority of those pairs, as you see. Stelio,
Sir.
What do we have from macro standpoint so we can pass it then to Andre?
Yeah, couple of things. We talked about the OPEC agreement, which apparently is being done. So they're going to extend for, 9 months, the production.
Yeah, to be honest, the market doesn't seem to have done much following that.
Yeah, it's all priced in. It was already, I mean, it did rally 3.5% the day before when it was becoming clear it's going to happen. So so that was kind of an non-event, like you said. We did have the Aussie, the Australian interest rate decision. They cut rates to a historic low of 1%, largely expected. Actually, the Aussie rallied on the back of it because the comments that they said were not
as dovish.
We're not dovish. Yeah, we're quite neutral. They did highlight the risks due to the global environment, but then again, they talked about good employment and growth being okay, but inflation is low. So that was that. The main number that came out today, and it was shocking, was the UK construction PMI. Expected 49.3 came in at 43.1, and this drop from the previous reading, you have to go back to the crisis in 2008 to find a drop like that. And
was it also were the construction PMIs also stowaways in a plane?
Yeah. But you know what? It's becoming very clear that this Brexit uncertainty is really starting to harm the economy. And there was stockpiling in the first quarter. It kind of masked a little bit the weakness. But it's all coming out now. And if I was a politician in the UK, I'd pay very close attention to this and look at the damage that's being done now. So they have to do something, no matter what it is, they have to go ahead and do something, because this is, like you always say, Steve, death by 1,000 cuts.
Yeah, it is.
So they really, really have to do something now. I have no idea what it's going to be, but yeah, it's scary. It's scary. And the last thing that not many people are talking about is that Iran, there's been an agreement that Iran have made some years ago where they limit the
enrichment of plutonium.
Yes. The uranium enriched, yes, exactly, enriched stockpiles, and they have breached it. So effectively, they're breaching this agreement. And again, another thing that can bring, who knows what this might bring. It's not a thing to ignore, and the market kind of doesn't care about it. Well, at least that's how I read it. So just another thing to add into the mix of this this environment, and it's not a good one. And with equities near all-time highs, man, I don't see what's going to bring equities higher now, unless the Fed cuts 50 or something like that. So
I think that there are a lot of things that can bring equities higher in the short term. But in all honesty, in a year from now, looking back, it's going to look so stupid if somebody actually tried to buy here with the intention of holding. You know what I mean?
Yeah, absolutely. And you look at valuations anyway. You look at them; they're high. So there should be an eventual correction. But you know what? We've been saying this for a year now, and it's grinding higher. So I am not short yet, but I'm looking for. I think we might get one more push to all-time highs, like S&P at 3,050 or something like that, and then I think that will be it for this leg. But let's wait for that first.
Yeah, indeed.
Okay, let's bring in Andre if he's here.
Andre,
I'm here. Hello, everyone.
Hello.
Hey, mate.
Good afternoon. Can
you know how to take this? You know how to take the screen.
My audio, it's fine. Can you confirm?
Yeah. Your audio is fine. Just
Andre Picasso is here.
Andre Picasso with the coach. How are you?
I want to see some artwork.
Okay, let me try to. Can I take the screen, Steve?
Oh, absolutely.
Sure.
Absolutely.
Andre, I visualize you making your charts with on an easel and painting them. All right. Look at that.
It could be worse.
Wearing a beret.
Yeah.
Portuguese style.
Portuguese style.
Yeah.
The great mustache.
Enjoy the rest.
Thank you very much.
All right, Steve.
I'm going back to the little dude. So
Thank you, Steve.
All the best, Steve.
Yeah, get some rest, bro.
For Jason.
It was great to have our nose and eyes and ears back on face today, man.
Absolutely.
Bye-bye.
All right.
Okay. Euro versus Australian dollar, and because Steve has mentioned it earlier, I also believe we will trade lower. This was a shark pattern shared among our community inside the ForexAnalytix. This was a short that I took also for myself. And this is the default target for the pattern, the 38% retracement. The market has felt some pressure there, but I still believe there's room. So at this point, and the reason why I'm pushing this chart is because I always like to share the strategy behind those trades. So at this point, at 38% retracement, which is a strong Fibonacci level, which should, and this is always my suggestion, break even our trades and pocket a portion of our initial position size. So we short one lot, two lots, whatever, we close a portion of that position size and we adjust our stop losses to break even. That allows us to, follow if the price decides to achieve other Fibonacci levels. That allows us also to keep partitioning our trade, and at some point it will allow us also to trail these trade setups. So I will put an automatic stop loss positioned at profit at some point, and that will follow if the price decides to keep trading lower. So we are now approaching one crucial level, which I believe it will make the difference between, more bearish momentum or a potential bounce. This bearish descending structure, resistance trend line, and the 50% retracement. The 50% retracement is actually the default target for the shark pattern, which tends to complete also, and please try to follow all these lines, which tends to follow, which tends to create or to form the 5-0 sequence, which tends to provide the trader a nice eventual bounce and bullish momentum considering this pattern. So we have a bearish shark pattern, and at the default target, basically we will retest this previous structure resistance. It's a pivot zone confirmed with this support level, support reinforced there. So I will not be surprised to see a bounce from the default target for the shark pattern below that level, and it will increase the probability to trade even lower. But below this structure trend line, or a few points below, kind of a false breakout below this ascending structure, the 78% retracement, and because the market extended above at 127 extension, a retracement to the 78% fib will print as the cipher pattern. So that will also offer for those who have interest to buy these markets, obviously always trying to respect these major structure support, fractal, weekly and monthly support level. So
Andre, I was just
yes,
curious, and it may be a curveball to you, but do you have any pattern in place currently working?
We can barely hear
yes.
you, Dale.
Oh yeah, my mic is down. Okay.
Oh, there we go.
I raised
Yes.
it when I'm drinking because the mic would get saturated. Anyway, drinking coffee. So I was curious if you had any pattern in place working right now.
I have this one, this cable.
Okay. Because it'd be cool for you to be able to explain your rationale for something that's live right now.
Sure.
Is that cool?
No problem at all.
Okay.
The idea is to try to identify those reversal points based on those Fibonacci ratios and criteria. So at this point, I engaged with a very small position size on cable. These multiple confluence of Fibonacci levels. So we are trading the 224 extension, the Fibonacci extension, from this swing, this last swing, printing this head formation there. We are now facing the bullish shark pattern. So, and because the market also printed this shark pattern there, I shared that pattern before. So, and the potential formation for this right shoulder, at that point I was expecting these highs to be to consider these highs as the right shoulder. The market has reinforced this support, and then a new high, and then a breakout below. So this was the first shark pattern at 161.8 extension, default target at 50% retracement achieved, and then the 5-0 sequence again, the same 5-0 sequence we have that I showed you before. the 5-0 sequence at 50% retracement and then new lows. At this point, we are now facing the 224 extension, which should offer me, and actually it's working.
Maybe so a little bit above the breakdown. You're looking for, so this will negate that breakdown of a head and shoulders, right?
That's
If it manifests.
the default target. The default target, yes. Okay. The default target will retest this. The 50% retracement will violate this previous fractal support, and yeah. Actually, it's a fractal resistance synced with previous structure support, and we need to assume, and we need to start to make assumptions, though, as soon as the price starts to violate some of the criteria. So we assume, if the price violates this structure and the next zone for the heads and shoulders, it can even trade even higher. Eventually, it will retest a daily fractal. But I trade based on the Fibonacci's. Right. So and because I know the potential to achieve those targets based on the pattern that we have. So the default target for the pattern is the 50% retracement. I have my stops. It's a very tiny position size, as I said before, with my stops positioned right below, so I can be hunted, and the market can bounce from a third drive, Dale, eventually, and it can happen. I will not negate that possibility.
Yeah, the reason I wanted you to do something that's live and active, and this looks pretty good, is because subscribers always have the information and the explanation where you can actually learn harmonics by just reading the commentary from Andre on, first of all, it doesn't have to be a pip, it's on many pairs that he covers. But now, instead of just pulling the trigger and not learning anything, going with Andre's call, like a lot of people do on signal services, they don't learn a thing. You know, if you're lazy and you just want money to drop into your account, maybe you'll get lucky and find the right manager. But if you've tried that before and had brokers in 2000 and 2007 that said that you were diversified and it didn't matter, they just don't have a sell button. This way, if you're self-directed, you can actually learn about harmonics by following Andre's analysis. So just want to give the people that weren't subscribers an understanding that when you're with us, you actually learn about this methodology.
Yeah, I absolutely. I always enjoy to share things before happening, you know, I always like to share also the before, actually not the before, the after the pattern being printed and the results for the pattern. Why? There's a simple process that is related to the repetition process, and I believe I'm here at ForexAnalytix for a while, so I'm actually for one year and 2 or 3 months already. I believe our community are already synced with the process to trade those harmonic patterns, because the brain already accepts the concept. But it's a repetition process. We need to embrace the process. We need to actually respect the rules behind those patterns. But there's only one way possible to achieve success trading those patterns. It's through a repetition process, because some of them will fail, very similar as any other technical approach which you can trade the market. So
key point about repetition, to form a new paradigm, or any paradigm, it's done with repetition. So
absolutely, and our personal life, exactly, our personal lives in our jobs outside the markets, for those who have jobs outside the market, it's always the same thing. We embrace a concept, we create a routine process, we repeat that process over and over again, and we achieve results for that. So trading is exactly the same, and basically I consider trading, I believe I shared this before, the same the same way I'm trying to sell a product to someone. I'm going into a meeting every day. I try to sell a product. Sometimes I will fail. Sometimes I will achieve a client. My patterns works exactly the same. Every day I sit in front of the computer. I go into a meeting. I try to sell my product. The product will sell.
How about
or
this,
the product
Andre?
will not sell.
Instead of
Yeah.
being a salesman, how about this? You go
I'm
into
just
the
using.
courtroom.
Yeah.
You go into the courtroom
Mhm.
with evidence and build your case.
Yeah.
You like that?
No, absolutely, and that's we need a plan
right.
to trade. We need a plan to put in action. No,
Yeah.
And let's try to talk about plans for euro versus dollar. So as printed before, and as I mentioned before, and because I always like to share those events, because again, repetition process will help you to identify those price behaviors inside the market. Double top at red, broken neck, resistance, bullish 2618, we buy the market to achieve a default ABCD pattern. And as soon as the market targets the ABCD pattern, the symmetrical, let's call it a symmetrical ABCD pattern, and let's project it from the close prices below to these highs. If we clone this swing from and if we position on that swing from the 6188 retracement, this will target the symmetrical behavior. So at that point, I shared that. Actually, I believe I shared that among our community. As soon as the price touches the 127 extension, assuming the possibility for a 38% retracement. And so here we are, 38% retracement achieved. At this point, I can imagine a consolidation period somehow during a period of time. I can see a rebound or a bounce from this level, retesting the highs, and I can imagine a cipher pattern printed at 78% retracement, also at the daily support. So this will print me one eventual cipher, which I actually at this point I don't think it will happen. Again, we need confirmation. We need the violation of this ascending structure trend line, as Steve has mentioned before, to trigger that eventuality at this point. I believe there's a possibility for a bounce from here. We are now actually entering, and I believe for the most common traders using the RSI at 30s, we are now oversold on euro versus dollar. Another one that I want to, if you need to interrupt you.
Well, you know what? There's a lot happening in the crude market. You know,
there's a
big
bat
debate.
pattern. Yeah.
Okay, so yeah, I was interested in your view. Plus, our guest does a lot in oil, so if maybe you're not prepped for it. If you're not, that's
no. It's a clean chart. It's a very easy to process. I believe we are trading bullish on oil at this point. This is just one small between commas a pullback.
okay.
At this point, I can see this as one eventual cup and handle. I will use my Fibonacci's there, and I will target for, I will project my default targets. Actually, not this one.
So you'd be buying fib pullbacks from here.
Eventually a retest of this previous structural resistance, golden fifth position there.
54.
Let me give you a price. I know that you need a price. 54.21. That is my that is the Fibonacci. That not mine, not my price. This is the Fibonacci retracement synced with previous structural resistance. So what we have more. So I can imagine. So usually we tend to search for these cup and handles as a trend continuation events. It's not usual to see these as the last pattern for the last corrective structure. It's not common to see it, but I will not be surprised to see again, a pullback, 50%, 61.8 retracement, and then new highs on oil as projected before. But let me also share with you, and let me use other fibs here. Actually, I need an extension, and I need to measure this very last swing from this high to this low. I need an extension from this swing, and I have three. Actually, I have 4 levels to show you. Why are they not here? Let me draw it again. This one, sorry. Of course, there's no fibs there, Mr. Andre. Okay. And I need the 88% retracement. So the BAT pattern that I was mentioning before, where is my 88% retracement? Okay. So the 88% retracement is the bearish BAT pattern formation. So we have I have a multiple confluence of patterns here. Let me use lines. So we have this first low, we have a pullback, double bottom, kind of, and 88% retracement. So respecting these highs, this is the bearish BAT pattern. We can expect the pullback here. Again, I use the same Fibonacci levels, the default target for the pattern at 38% retracement adjusted to those highs. So I admit the possibility for at least to the 38% retracement as a minimum expectation for the pattern. The 618 retracement is usually the second target for the BAT pattern, and this one is synced with this previous structure resistance, and that is one of the reasons why I believe there's a probability to see oil retesting those lows.
Great analysis, man. You clarified a lot of things for me.
The cup and handle, I'm not sure if you agree with me, Dale, with this eventual cup and handle formation. I have a projection above.
I would if I knew about them, and I mean, cup and handle. I'm a one-trick pony.
No, you have a lot of experience.
Three drives.
Yeah, for sure. You have already at some point you have crossed. You have been crossed with those patterns. So
okay, wow, there, huh?
The 200%. It's a cup and handle projection. Yeah. So if we admit this and if we consider this as one eventual cup and handle, and the market will prove with a breakout above or not, if the market breaks above this structure, it can validate that as a potential cup and handle. It will trigger for sure more bullish, more bulls positioned above. So I believe if the market starts to actually trade above this structure, it will trigger a lot of people, will trigger those longs. This is a default projection for the pattern, for the cup and handle, 68.71. And those are the Fibonacci levels where I admit some pressure based on harmonic trading or harmonic patterns. 88% retracement, the default bearish BAT pattern, again, default targeted fibs. If the market decides to trade higher, the 161.8 extension, the crab pattern above. So between those, we have also the 113 extension, which can print us a false breakout above. The 113 extension is the alternate bearish BAT pattern. Actually, the market is now nailing this previous structure support, but do not ignore, and let me try to go into 4-hour time frame chart, and let me try to sync this process. I see more bearish momentum, at least retesting this 200 moving average, but yeah. I never ignore the possibility to see new high or a retest of this structure with a new high, printing new highs.
Before the pullback.
Before the pullback. And again, I use always the 113 extension to identify the false breakout of the structure. So if the market decides to trade, so what I need the market to confirm trading above the 113 extension. That will violate this descending structure and will confirm the market tends to search for the next Fibonacci extension. That will be the 168 extension, retesting those highs above. Do we have an interview?
Yeah.
Dale?
And
Okay.
I'm so glad I asked you about crude because Kirk, does a lot of work in the energy patch, has some ideas about some of the fundamentals. So it was a great segue. And as usual, Andre,
it will be awesome to listen his own opinion about the energies also. Just to finish, Dale, another event shared among our community, which I take the advantage being here to invite all those which are not our subscribers to subscribe at least for a trial and try to get synced with the platform. You'll be amazed with the amount of information you will get among the community. This was one amazing chart that I want to share with you because I love those events and I never tired to share the 2618 trade setup. It's very similar with euro versus dollar, obviously inverted, now trading the 38% retracement. Again, at targets, overbought. The market is trying to threat the previous structure resistance. I admit the possibility to retest just a few points below this fractal, to retest 96.45 or eventually a few points below or around those levels. I admit dollar index trading above this small structure printed below, a retest of that structure, and we will see from there if the market decides to bounce or to print new lows. We have also no bullish divergence between those lows, which may suggest another low, and that one with bullish divergence. We may search for bullish divergence if that happen, and eventually
I'm with you on this.
Yeah, we will see a bullish bat pattern printed at 88% retracement. There's a lot of confluence there between the 224 extension, 113 extension. I need time to explain all those fibs, but there's a lot of confluence there.
95.40-ish?
95, exactly at 95.40s. This is what we call the default major bullish bat pattern at 88% retracement. Let's at least this is what I'm expecting for dollar, and eventually it will happen from this Fibonacci level, the 38% retracement shared among the community. Again, I invite you to join us. 96.81, it was my target for this bounce. I admit, I strongly admit the possibility to see new lows on Dixie, and that finishes my introduction for harmonics today. Thank you very much, Dale.
Thank you so much, everyone. Buddy. My trading warrior brother.
Thank you very much,
Andre. Okay, Kirk, I'm going to promote you to panelist. I know this is a new platform for you, so let me make sure you're unmuted. I've just unmuted you, and there is a screen share.
All right. Can you hear me?
I can hear you.
Oh, that makes me so happy.
Oh, it's nice to hear your voice, Kirk. Been a while. So if you just hover your mouse around the menu, here it goes. Okay.
All right. You got my screen? Great.
Got your screen. So good time to be talking to you since, how long have we been having these conversations?
I think going on 2 years.
Okay. And I remember a couple of years ago when no one was talking about a possible conflict with Iran, you were. Is there going to be a hot conflict there, Kirk? What do you think?
You know, I talked about it about 2 years ago and got mocked pretty heavily when I said that we were on the path to a confrontation with Iran. And now that we are at the doorstep, the question becomes, are we going to enter? And
Well, we were a few minutes away a week ago.
that's what they say.
Okay, so I'm interested in your intelligence, what your view is here, and I'll shut up.
Well, you know, I think that we're in a situation where there could be a conflict there. I highly doubt that it'll be with U.S. boots on the ground unless there is some sort of internal overthrow where we would support it. But the idea that there won't be missiles, that Israel wouldn't do something, I think is pretty naive. And I've always thought it was pretty naive. Iran just broke the nuclear accord by enriching too much uranium. That was reported yesterday. So the odds that President Trump wouldn't have a response to that, I think, are pretty low. So we'll see what happens. But at a minimum, I think that the tensions remain. The sanctions remain for an extended period of time. I don't see the sanctions coming off of Iran this year or next year. Do you?
No, not until after the elections, maybe. I'm curious. You're showing Stratfor up here. Did you write for them, or this is just
No?
you agree with their assessment?
There's somebody who I have been using for around a decade, maybe longer.
Okay.
And their quarterly outlooks, I think, are pretty valuable. So they just happen to have two paragraphs that fit very nicely on the screen that I thought I'd put up there. And both of these things impact oil a lot. Oil has been suppressed despite the OPEC cuts and despite rising demand, because people fear that demand will fall off because of slowing growth due to tightening global trade. And I discussed with my subscribers recently, last Friday actually, that first fear that global trade decreasing, leading to decreasing global GDP growth, might not have the same correlations that it has in the past. We know that from machine learning that supply chains are going to move closer to customers when they can. So is it really as big of a deal today that comparative advantage for manufacturing isn't moving to China or to Vietnam or Mexico as much anymore? Does it matter to global trade and the global GDP that because a robot in China is the same price as a robot in America, is the same price as a robot in South America or Europe or Mexico, are those same correlations between global trade and global GDP going to persist? And I don't believe that they will. I believe that you're going to see a world, and clearly we'll have a transition that's very tradable. I believe that over the next several years, as supply chains move for various reasons, one, President Trump pushing them to move, but also machine learning and automation making it happen anyway, that global trade, the nature of it is going to change. And it's not necessarily going to make economic growth slow down. So I think that there's a lot of fear based on global trade, which has historically been almost perfectly correlated to global GDP growth. People are afraid that global trade decreasing is going to decrease global GDP growth. And I don't know that that's the case anymore. I think there will be some correlation, but it won't be the direct, almost one-to-one correlation that we've seen in the past.
Okay, well, can't we have slow global growth and a supply shock? That even a slowing global economy will not slow down price appreciation of a commodity that's having supply issues?
I agree. So
Stagflation 2.0.
Right. I think that, first of all, I don't believe that global growth is going to slow that much, not in the short term. You know, we're getting some minor indicators that growth isn't going to grow as much. There won't be as much growth.
Okay, so then what a great contrarian trade to be shorting bonds here.
Right. Well, maybe.
Because they're priced for recession.
Right, they're definitely priced for recession.
Okay, and the expectations for the Fed, not just a cut, but maybe a half a basis point, and 4 in the future. Do you think the Fed can hold up the long end of the market, even though they're playing with the short end?
We'll see.
Okay. I mean, it's just a
think,
gut feeling I have in some technical things that are saying and how crowded the bond trade is, Kirk. So
right.
I'm just wondering where your head's at on that, since you don't seem to be buying the narrative of a global slowdown.
No, like I said, I think there will be slower growth, right? My theory has been for several years, since my market watch days around 2015, 16, I said that we were going to get slow growth forever. And what is slow growth forever? Slow growth forever is the combination, mainly led by demographics, right? Aging demographics, slowing the economy down, and machine learning and technology, which is disinflationary, and then the gigantic global debt overhang. It's going to be difficult for us to get the same growth this century as we had in the second half of last century. And people try to find quarter-to-quarter reasons for that, but the reasons aren't quarter-to-quarter. The reasons are very long-term. There's very long-term pressure on growth. But the counterweights are the central banks, fiscal policy, the changing narratives and spending habits of large generations, particularly the millennials. What is technology driving as a shift in employment? All of those things. So, you know, you have people running around out there calling for some big bubble to burst. We're essentially in the same place as we were 12 years ago. And that means that to some people that, well, then we have to have a crisis. But 12 years is a lot of time for that money to spread around, for the inflationary impact of money printing to change where the nominal numbers would lie. So I don't believe that we have a lot of bubbles right now. That doesn't mean that we won't form them through further bad policy, but you know, we made a lot of money this spring on TLT, right? As the long bonds came down, we made a lot of money. I'm not in government bonds right now. My asset allocation, in fact, I just printed that for my subscribers. I can show you. In April, we went to an asset allocation, depending on how aggressive or conservative you were, 35% cash, but we dumped our government bonds. So we don't have government bonds right now. Why? Because the Fed is acting as if they will lower interest rates a little bit. Will that impact the long end of the curve? I don't think so, because I think the smart money realizes that slow growth forever is a real thing, that we're not going to suddenly have a bunch of ripped off 4% prints or even 3% prints. You know, we had the sugar high from the tax breaks, but the reality is until we get very good fiscal policy, until we rebuild the infrastructure of the planet, in particular energy and water, growth is going to muddle along. You know, we've heard John Malden and other people talk about, the economy will muddle along. It won't be spectacular. It won't fall off a cliff.
I'm just trying to understand. You got out of bonds, but you still think the bond market is lower, rates are lower for longer. Why would you liquidate your bond? Why did you liquidate your bond position?
Because the easy money was made. I'm not in the hard money. So
Okay.
when rates went from, what was it, 3-ish down to 2-ish, that was easy money. From 2 to 1, who knows?
Okay.
And when would that happen? Now, you guys are much better traders than me. I'm one of the worst traders.
Oh, don't use that. Go ahead.
So, you know, I am sitting on cash mainly because, you know, and I catch grief for this, but I've called the presidential election correctly every single time since 1988. From college to the last one, I called President Trump winning. And I think it's very easy to see that he's going to lose next year. So if he's going to lose next year, you know, 8.8 million votes the Republicans lost by in the midterms. That's almost triple the triple what the popular vote was in the presidential election. So the odds of President Trump winning next year are incredibly slim. I put it at somewhere between 6 and 13% that he would win. So if I think he's going to lose, then what is going to be the reaction by investors? Well, given that there are huge tax breaks right now for investors, you would think, and we saw this under President Bush twice, front end and back end, investors sold to preserve the tax breaks on their highly appreciated assets. I think that next year is going to see a fourth quarter very similar to 2018, where things started off choppy and then fell off a cliff. There aren't a lot of marginal buyers in the markets in general, and that's not going to change. Even with the Fed ending quantitative tightening, which will definitely probably give us another sugar high in September, if you have a lot of big investors, the type of investors that control 70-80% of the money in the market, selling to lock in gains because their tax rate they think is going to go from 10 or 15% up to their marginal income tax rate, which is what I think the policy will probably be. You're going to see big time selling, and there's not going to be anybody there to fill the gap. So could there be another trade in bonds next year? I think so, especially if, you know, the long rate, rises a little bit and you see, you know, policies that allow it to happen. But, you know, the short end of the curve, we should have learned, does not impact the long end of the curve all that much anymore. So if they allow, you know, a little bit of a rally, people, you know, sentiment drives things, you know, then you could see the long bond tick up, what, a half a point. I don't think it'll go back to its highs, but, you know, or back to its high interest rate. You know, then you could get another trade in bonds on fear late next year sometime. Okay. But between now and then, what do I think? I think I'm looking for a small pullback over the summer. I think that I'm probably going to buy the tech companies short term, as long as there's hope of an agreement with China. But my big investment right now is oil, because the OPEC cuts are real. Russia is not hindering them. Excuse me,
buddy. It's all right.
I just got back from 3 weeks in the desert, and I'm adjusting to Wisconsin pollen and humidity. But
okay. So I thought maybe you ate some sand.
Oh man, I tell you what.
All right. So, you know, I follow one of your favorites here, ECA. So that's still a hold, and at these levels at 514, you still like it, right? Because we're only, you know, when you go back and look at like weekly ranges, we're way down there. I mean, you know, a year ago, in the spring, this was trading $13. Looks like we had that break to 5 or so, and we made new lows recently. I'm looking at the weekly. A lot of divergence in it. Looks like a second drive to me, and potential low. So you like it down here, and what's think we could challenge last year's highs, Kirk?
Yes. However, I wrote a pretty long article about this, why oil stocks are priced for Armageddon. And some of the factors include the divestment movement. So the divestment movement has been remarkably successful. So you have 350.org has gotten over 1,000 institutions to commit to selling their fossil fuel investments. And
okay, so I'm showing the chart. If you look at the screen, I'm showing ECA here.
yeah, I mean, the whole, and if you use XOP, if you can overlay XOP, you would see that it just really all fell off a cliff, and that has to do with two things. One, there is just general sentiment against oil, and that matters. And you have a lack of marginal buyers in the markets in general who prefer to invest in marijuana stocks and technology and anything that's technology related. The millennials don't invest a ton of money yet, but they're not investing in oil stocks. And then in Norway, back in March, announced that they're going to start divesting. So if you saw the list from Norway, it included every stock in XOP except for one. Norway sold every single one of these stocks. And they're the biggest sovereign wealth fund in the world. Now, they're selling, and you can tell by the sideways movement of this chart now in the last several weeks anyway, and a little bit of a rebound. Norway is probably done selling. They've sold 7.6 billion or whatever it was of assets. So
are you price sensitive to entries when you have a narrative and a theme for your subscribers, or how do you approach entries with it's the art of this business is not if, it's when.
Right.
So
right.
I know you say you're not a short-term trader, but even if you're a long-term trader, are you price sensitive on your entries?
Yes, and I've not been great at it with the oil.
Okay. And how about risk management? Do you know when you're getting in how much you're willing to risk on that position?
You should. I do.
Okay.
I think a lot of people overextend, right, because they scale in. I'm looking for absolute value and then momentum back up. And a lot of people scale in every 2 or 3%, even though the folks I work with are position traders, right? Looking at 1 and 2 and 3 year intervals.
Okay. What was that first term that you used? You looked for what kind of value?
It's just absolute, intrinsic value, right?
Okay. Does ECA have intrinsic value at 514?
If they were to liquidate, they'd get over $10 a share.
Okay. So that's what you mean. So the assets versus the shares would price it up at 10.
Right.
Okay.
And that's based on oil around 60.
Okay.
If oil is around 80, it's $20 all day long.
Okay. Is that what you think is going to happen here? You're looking for $80 oil?
I've been saying $80 oil for over a year now and consistently been wrong because, one, President Trump kind of tricked us on the Iran sanctions the first time. We got the big fourth quarter sell-off. We have all the growth fears. So
how about this? I learned this from a legend, Peter DeSorio at Fibo SR. The market's job is to convince us it's something that it's not.
Right.
So it's been doing a pretty good job on you, bro.
Yeah, no, they got me. Right. So, I mean, I don't make a lot of big mistakes, but the whole...
I know you have poker to supplement your income, so I'm not worried about it.
I did pretty well at that, too.
Okay.
But, You know,
Well, I'm just wondering if I should start scaling into ECA here at $5.
so I think that if you haven't, take a look at the way that's forming on the bottom there.
Yeah, I see it. I'm showing
It's very constructive now.
it's yeah, it definitely started to show some divergences on larger time frames. Let me look at the 4 hour here. Yeah, 4 hour. It is acting constructive. Okay, I agree. Let's see the 1 hour.
So
That's as short term as you get. Okay, yeah.
That break where it fell down,
Yeah.
I mean, you
This
talk
one, you
about
mean?
fooling me once.
You mean last winter?
No,
Or this one?
here in May.
Okay. Okay, yeah. So with the market, it actually led the market down.
Right.
Okay.
So I really thought that it was going to move the other way. I thought that all the fundamentals were in place, and sentiment, you know, the what the crowd wanted to do was something different than what I thought it should do.
Yeah, but let me just remind our audience that when you were looking at things like Chesapeake a year ago when we had that very nice rally, you had call positions on, and you participated in that rally. So anyone that thinks that anyone can be right all the time, let's shine a light on it. But it's we all go through drawdown periods, and what do you do psychologically, Kirk, to keep your head in the game? Some people just need to walk away for a while when they go through a rough patch. What do you tell yourself? What's your self-talk like when you're going through a period like this?
Well, me personally, I'm not tremendously emotional because I've been doing this so long that I just know that every fifth trade or so, I'm going to take one in the shorts. So I just end up on the poker tables. And then I make myself
yourself.
Yeah, I make myself feel better by taking people's money there.
Okay.
But
I watched Rounders again last night.
Did you really?
Okay, yeah. So you're are you Matt Damon or
no, I'm one of those guys in the background that doesn't get into the game.
All right. Well, I tell you what, Kirk, it's always easy for people to come on and toot their horn when they're right. But it takes, someone that's authentic to be real with people and say that once in a while, it's so hard to say, but it's cathartic. I was wrong. Or even, I don't know. But, your farsightedness on Iran is amazing to me. And I have a lot of respect for you, my trading warrior brother. And I know that you're gonna have 4 winners in a row and a great 4th of July. And when you watch those fireworks go off this year, Kirk, after they explode and the trails start coming down, may those be pips that just rain down on you for the rest of the year.
Well, I do appreciate that. I have one thing before we go, and you can maybe share this with some of your trading buddies. I would take a look at Devon Energy.
What's the symbol?
DVN.
Okay, hold on. $28.90 last. Not open yet. Okay.
So I maxed out my position last week while I was in Vegas. I like the way that this is behaving, and I mentioned to subscribers in the last 6 weeks or so, we know that Devon Energy is actively engaged in merger talks. And I think when that happens...
As a target or as the acquirer?
It looks like it's going to be a merger of equals.
Okay.
If I had to guess, and I've been trying to get the information, but, it's not public, so I haven't been able to find it.
Oh, Gordon Gekko and Bud Fox will get it for you.
Yeah, right. It wouldn't surprise me.
Bobby Axelrod in the modern era.
Right. It wouldn't surprise me if they merged with Marathon Oil.
Okay, and you think it's accretive, and That'll make
right.
shares
And
appreciate.
you know, you take a look at companies like Devon Energy, who's willing to do a merger, or you take a look at companies like Concho or Pioneer, who are Permian pure plays, and they're cutting their expenses dramatically. So if they can keep production gently rising with 25 and 30 and 35 and 40 and 50% less personnel, that's a lot of money that's going to drop to the bottom line. And ultimately, if the markets don't drive these oil stocks back up, you're going to see a lot of take privates, because these oil executives aren't dumb. They know that there's another decade of oil demand out there, right? Oil demand's not going to fall off a cliff for at least a decade, maybe two,
Okay.
you know, based on electric vehicles. So these oil executives know that if the market's not going to give them a price on their stock, which is one way that executives get paid, then they're going to take these companies private. And they're just going to become massive inside owners of these companies. And they're just going to flow all that money into their pockets as these companies become more and more profitable. You know, the wildcatters are already going bankrupt. So the survivors, these mid-sized companies and a little bit larger, all the way up to Occidental. I love the Occidental Anadarko merger, and I love that Icon is involved. Icon is going to get Occidental to sell off all their non-core assets, right? He's not going to undo the merger, but he's going to get Occidental, he's going to push them to sell off all of their non-core assets, which they are already doing, but Icon will make it happen faster because he's got no patience. So a lot of these companies are going to make money, and the question becomes, how much? Do they go private and they make us a little bit of money, or do they stay public and get managed well and triple our money for us? I don't know. But I think there's very limited downside in these. X a recession. If there is a recession, then you get another buying opportunity. So you might have to trade it. And as I said in a different article several months ago, I think in January, oil investing is dead. Oil trading is alive and well. So, you know, I think that these are going to be some of the most tradable stocks in the market for you if you're a trader. And the price of oil, I think, just keeps drifting up until, you know, there's that EV moment where people go, oh my God, oil demand's going to start falling. But between now and then, I think you can trade these, and, you know, if you're an option
Buy
trader,
the dips
man,
and take profits on the rips.
yeah.
Okay.
Yeah, I think if you're an option trader, you can do very well with these.
Okay. All right. Well, Kirk, thanks so much for hanging out with us today.
Yep,
And,
you have a great long weekend. It's I wish we had time to tell poker stories, because I have a bunch of them. But I did write a blog. So the blog is titled Poker Investing in 3 Weeks in the Desert.
Oh,
So,
cool. And
yeah,
people could find this where?
just Google it. It's on Seeking Alpha, but if you Google Poker Investing in 3 Weeks in the Desert, I think there were 6 or 7 blogs.
Okay. And you can also follow Kirk on Twitter at Kirk Spano, S-P-A-N-O. Am I pronouncing it right?
Yep, and that's probably the best way to track me, because my Twitter feed leads to everything else.
Okay, Kirk. Well, have a great summer trading season. It sounds like you're going to have to start using daily charts and not just monthlies anymore. So,
Yeah,
you
You're
know.
going to make me work harder.
Yeah. Okay. Well, you know, keeps you young, bro. So, thanks a lot for being with us and sharing some ideas about Devon. And, you know, you were one of the first to talk about potential conflict with Iran. So I really appreciate you coming in and edifying our community every once in a while, Kirk. Let's get back together in the fall and see what's going on, okay?
All right, you take care.
All right, everyone. That's Kirk Spano. That's a wrap for Turnaround Tuesday. Remember, don't just count your pips, count your blessings. I count people like Kirk who come in and, you know, with their giving spirit to try and give us information that may be actionable, and you guys for hanging out with us. So, adios. See everyone tomorrow. Lydia Iden Finkley at Faith Might will be with us to talk cable.